Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned
compliance with GASB 77 reporting requirements. I'm happy to introduce today's speakers, Jim Lanzarotta and John Tysseling. Jim is the national practice leader for the firm's Government Services Group. He is currently the AICPA representative to the Governmental Accounting Standards Advisory Council, a group of leaders responsible for helping the GASB in setting its technical agenda and with issues related to the financial accounting and reporting by state and local governments. He completed 6 years of service in 2012, the last 3 as chair of the AICPA State and Local Government Expert Panel, responsible for reviewing all proposed governmental accounting and auditing standards and providing feedback on behalf of the AICPA, as well as updates to AICPA publications, including the Audit Guide to State and Local Governments, Audit Risk Alerts, and Practice Aids. Jim has been working with a group of Oregon County assessors in an effort to assist local governments in Oregon with the implementation of GASB 77. John has more than 30 years of experience providing applied economic analysis of business transactions, market structure and performance, regulatory policy and issues, efficiency, capital investment planning, and economic forecasting. He is a consulting director in the Albuquerque office of Moss Adams and has been professionally engaged to address all aspects of the economic value chain, including production, commercial transactions, commodity value pricing, tax policy, market regulation, capital infrastructure, and rate design. Dr. Tysseling is trained as an economist and has served principally in private sector engagements, but his professional qualifications also include several government positions, including serving as chief economist for the New Mexico Taxation and Revenue Department. John has testified widely on competitive markets, market regulation, taxation and utility matters in state and federal jurisdictions, and has an extensive publication and presentation record. Jim, I will now turn the line over to you to begin today's presentation.
Well, thank you, Pam, and welcome, everyone. I find myself in an interesting situation today. I'm actually stranded at home. I live in Eugene, Oregon. For any of you who have been following the weather up here in the Northwest, we had quite a snow and ice event. Rain that developed in California moved up into Oregon in with the cold air here. So anyway, I'm stranded at home in an ice storm and can't get out of my own driveway. And I bring it up only because our power has been a little bit iffy here. So if I cut out, I will do my best to join right back in, and hopefully John can cover me. But so far this morning, things are going pretty good. So today, what we'd like to do is cover GASB 77, and I think you'll find, in terms of an accounting standard, this is pretty easy in terms of the requirements of the disclosures, especially in light of GASB 68 that we've all had to deal with the last couple of years. But what you're going to find today, and John and I clearly in the midst of this, is that the issue isn't so much how do I, put words into my footnotes to meet the disclosures, but all of the issues in terms of how I get the information, the different stakeholders involved, the implementation issues that we're going to face, how do we measure these abatements to come up with the dollar amount, and just all the collaboration that will be necessary. That's been the real surprise to this. And I think the other piece, John, that we'll discuss with everyone is just that this has kind of flown under the radar because I don't think it has seemed like a big standard or a big issue, clearly not on the heels of GASB 68 and some of the other ones that are coming down the road that have gotten a lot more attention. So that's our agenda. Before we start, though, we'd like to hear from you. Perhaps you could help us out with a little poll here and tell us, if you were to rate your awareness of GASB 77 before this webinar, how would you respond according to these choices? And if you could click those pretty quickly here so we can be sure to move through the materials. And so click the best answer and then hit the submit button. And we'll give that just a few more seconds here. And we'll see what you all think about your level of awareness so far. Okay, we'll go ahead and click through. So we'll be pretty quick in these. So here we go. Pretty much what I would think. John, any surprise there from your perspective?
None. It is common to have some awareness, but no specific understanding.
Yeah. Okay. Well, and so that's the reason for our webinar today. We're really trying to help increase the awareness. So you might kind of just start, well, why are we even here to talk about this? And it's been interesting having a seat on what's a terrible acronym, GASB. So the Governmental Accounting Standards Advisory Council. There's about 30 organizations, AICPA is one, that has a seat at the table, and we meet with the GASB board about 3 times a year to talk about all of the projects in process, to read staff papers, give feedback. And early on, the GASB polled a number of users of financial statements, and they were concerned about constraints on tax revenues. Most of the users I think they heard from were market participants in municipal bonds. And as you know, tax revenues tend to be a significant repayment source for municipal bonds. So these users got on the GASB's agenda and moved this up enough to where they felt it was important to give readers more information about constraints on tax revenues and sustainability of tax programs, and to improve the transparency of some of the taxes that an entity will not collect as a result of some of these abatement programs. So that's kind of the genesis. The interesting thing about it is the members of GASAC all agreed that this is useful information, but there wasn't consistent agreement about the location or the geography within financial statements. Quite a few participants, the AICPA included, said, hey, this might be useful, but could we park it in supplementary information or somewhere else and not in the footnotes? And unfortunately, the GASB stuck to their decision to leave this as a disclosure requirement in the footnotes. And the footnotes are part of the basic statements, so it raises the significance of this from a preparer standpoint. And unfortunately, it increases the significance from an audit standpoint because we have to determine whether there's material compliance with the accounting standards in disclosures, just like numbers that run through financial statements. So that's kind of the background. Let's talk a little bit about the definitions, or what's scoped in, what are the requirements. And our intent today isn't to give you a complete, technical understanding to be able to walk home and just do the disclosures. I think we want to spend a lot of time on the implementations and the collaboration and the stakeholders involved, but let's at least get far enough into this so you kind of know what it is that we're talking about. So the first step in this is to understand that this is associated with tax revenues only. So the first element that scopes this in is that we're talking about taxes, property taxes, excise taxes, sales taxes, gas taxes, anything that is a tax. So basically, if we're talking about fees, permits, charges for services, grants, intergovernmental revenue, those are not within the scope here. So it starts with a tax. The second element is there needs to be a reduction in that tax. So if we have a tax program but there are no tax reduction elements to it, that will not be scoped in. So we have a tax, there's a reduction for some reason, and then this gets into a little bit more of the what scopes it in. A big element is an agreement. There has to be an agreement that's entered into ahead of time between a taxpayer and the government. The government promises to forego a tax, and then the taxpayer agrees to take some specific action which gives them the right to that reduction. And generally, these are economic development programs, but there could be, as we're going to find out, there could be other programs, so they're not all just about economic development. But most of these we're going to find are for programs that help attract a business or attract labor or retain a certain number of employees. Perhaps it's to attract a particular business. But there are other things too that fit in this. So multiple residential housing or low-income housing may have a tax reduction element to it.
I think, Jim, it's also important to set the context of this in terms of an effort to provide increased public cost transparency in annual reports. That is, the ability of government to meet its financial obligations is part of the goal in these disclosures.
Thanks. So once we've identified, and we'll talk more about this because there's a lot here in this definition which that needs to be talked about. It's not that easy, so we'll get into that a little bit more. But before we go there, let's again just talk about some of the requirements. So once you've got an abatement that you know it's scoped in, these are the specific things that require disclosure. So identification of the type of tax. Is it property, excise, sales, gas taxes? What is it? The second is the authority for it. And most states, this could come down to state statutes that provide for the program, or perhaps there could be a local ordinance or resolution if this is a local tax that a government has the ability to assess. What are the eligibility criteria that enables you to take advantage of that abatement program? What are the abatement mechanisms? So for example, in Oregon, we're finding it's primarily property taxes that are scoped in, and the abatement mechanism might be a reduction in the assessed value of a property, for example. Other abatement programs could be a reduction in rates and so forth. If there are recapture provisions, so for non-compliance or those sorts of things, if there are recapture provisions, those would go into the footnote disclosures as well. And then what are the types of commitments? The originating government may have some obligations or commitments as part of that program, and then the recipient probably has obviously will have some commitment that enables them to receive the abatement. So the saving of jobs, the new job creation, a new business located, those sorts of things. So those are the things we're disclosing. Another important disclosure, though, is the dollar amount of that abatement. And that's going to be a tricky thing as we get into this presentation. And then the commitments I had talked about. Now, the other interesting element is that not only do we disclose the abatements that originate within our entity, but there's also a requirement to disclose abatements that affect my revenue, but they originate somewhere else. So you could have perhaps an income tax that is assessed and collected by a state. The abatement program might be at the state level, but then a net amount is passed through to a local government. So a local government is impacted by that abatement program and would need to meet these disclosure requirements as well. So an identification of the government that originally entered into that abatement, the specific taxes abated, the dollar amount, and so basically that impact on the revenues at a local level. So this is an element that's going to be very tricky, John, in folks being able to comply with this particular standard.
It's going to be a requirement for a good deal of communication between the government entities in order to accomplish this reporting on a timely basis.
Yeah. And we'll talk a little bit more about that here coming up. But so then here's the when it's applicable. So it's for fiscal years beginning after December 15, 2015. So for most of us, most governments are on June 30 year ends, not everybody, but majority seem to be. So this is coming up for the fiscal year end, the fiscal year ending June 30, 2017. And then anyone who has after that. So it's coming up, and what we're finding is that the taxes that are being abated are happening right now. And so the data set to draw from are things that are happening right now. For property taxes, at least in Oregon, it's the property taxes that are being assessed and collected right now form the basis for this first year anyway for determining the dollar amounts and programs involved. And we report on an accrual basis, so we don't have to necessarily wait until the end of the year and know the exact dollar amount actually collected after discounts or after the period of time goes by that we actually get the cash. It doesn't follow the cash, so it's an accrual concept of the dollar amount of that tax abated, and so we pay less attention to the actual time frame for when the tax is collected. And there may be some confidential information associated with abatement programs, so the standard allows for certain information to be carved out or at least disclosed at a high level without perhaps putting names of the individual taxpayers or so forth. So if there is some legal issue about confidential information, the standard has a provision to allow for that. And John, with that, why don't I turn it over and have you help us through some of the stakeholder issues that we're going to face with this.
Thank you, Jim. As we have had discussions with respect to the implementation of GASB 77, what has become very apparent is there are quite a number of groups of stakeholders that have a responsibility or an interest in the reporting that's required. One of the really common topics in government finance right now is tax expenditures. It is actually a subset of tax expenditures that are defined as tax abatements, but the focus is on the public cost, not the benefits of a particular tax program. So there is a host impacts that relate to the shared interests that are reported, but the activities that we were going to be talking about here are particularly related to the general statement of stakeholder interests. Turning then to just a quick definition, tax expenditures are a concern today with respect to government transparency issues. Tax expenditures simply are programs that are employed to lower the taxes paid by taxpayers associated with the performance of specific actions. It has a broad definition, and that includes tax exemptions, tax deductions, a variety of other credits, as well as the tax abatements. We, in particular, want to exclude tax programs that define the tax base. That is, programs such as veterans exemptions from property tax, where there is simply a statutory provision, most likely, that identifies how some activities are excluded from the tax base and tax liability responsibilities. These are better illustrated in this next slide, where we have developed a depiction of how tax expenditures have a broad definition, but that definition primarily relates to a reduction in tax revenues, one of the first criteria for a tax abatement. The second criteria for an abatement is the existence of an agreement. That is, the government will reduce taxes if there is some specific performance. The third element is that a tax abatement must serve a specific public purpose or goal. Therefore, issues such as economic development, tax programs, environmental, historic preservation, housing construction, a host of programs that have a specific public beneficial purpose are a critical component of identifying tax abatements that must be reported in the financial statements. Those agreements are very much a tool to achieve those goals and may include other activities such as job training or infrastructure construction, that it becomes an additional obligation of the government, and those are to be disclosed as well. One of the interesting results from GASB's research in advance of implementing the standard, they did a survey of some 78 governments, and in that survey, they identified a range of tax abatement programs that were identified in about a quarter of the cases. The government entities identified just 5 or less tax abatements, but that range increased to some programs or some jurisdictions where there were more than 200 programs that were considered tax abatements. That occurred in nearly 1/8 of all of the governments that were surveyed in advance of implementing the standard.
And John, just to support your comment there, in Oregon, working with the county assessors, we're finding that there's over 130 tax reduction programs. However, There's roughly 20 that have an agreement associated with them that likely need to be evaluated to determine if they meet this narrow scope. And we're still working on that, but it's looking like maybe up to 20 programs or so out of 130 likely will be scoped in given the requirements that you've gone through here.
One of the really interesting components of GASB's treatment of these agreements is that they would consider an agreement that is on its face unenforceable still to be an agreement that needed to be reported under GASB 77. That is, the concern isn't so much about taxpayer compliance with their performance obligation, but government's abatement of taxes in anticipation of that performance.
You know, another thing that's kind of tricky with that too, John, is that not only it's not focused on the legal compliance by the taxpayer, but the agreement doesn't necessarily even have to be in writing, which is a little scary as we work with different states and different taxes to determine if there is an agreement, when possibly you could have a situation that doesn't reduce that agreement to a writing.
So, to summarize, there are three features that in combination establish the tax abatements that need to be reported. You must, in combination, have a tax program that has a purpose of abating taxes. The type of revenue reduced by the tax program is a component of the analysis, and the existence of the agreement has to, all three in combination, be in place prior to the performance under the tax abatement program.
And that the prior to performance piece is a critical element. I know in Oregon we had a meeting with the assessors just yesterday, and one of the questions came up, well, what about a program? One was in particular on a solar projects. There's a tax reduction program in Oregon for solar projects, and you can have someone buy into a building or a property that has solar eligible solar equipment on it. That new buyer can step into and be eligible for the tax reduction. And we don't have a specific answer to this, but I'm suspect that this prior to performance element may actually scope that out. We won't know for sure probably without a consultation, but a very clear element in the standard is that the agreement needs to, and the agreement needs to happen prior to the eligibility to get the tax reduction, and that hopefully will help us to determine which programs are in or out and limit the number of programs that are actually scoped in.
So I guess turning to what we've discovered to be one of the most intriguing and possibly difficult aspects of this reporting requirement is the impacts on other government entities. You have a authority, say it's a county government, that enters into an abatement, but there may be both upstream and downstream entities that are directly impacted by that tax abatement. The example here is an industrial revenue bond that reduces property taxes, but that directly impacts the revenues distributed to various hospitals, public schools, flood control districts, other public improvement type of entities. And all of those entities are stakeholders in this matter. The other issue is the annual financial statements are the critical component here. That is, if you are reporting a tax abatement in this year, you need to measure your ability to fulfill your financial obligations as a government entity in that year as well. So there is a requirement that any reported tax abatement be evaluated in that current year situation, how that tax abatement would reduce revenues in the current year for the necessary financial obligations of the government entity. But regardless of the origin of the abatement agreement, it must be disclosed by affected government entities. What comes of that, quite simply, is a substantial interdependence between the stakeholders in assessing the impacts of these tax abatements. So let's turn to another one of the polling questions. And in the context of our discussions so far, in which of the following tax programs do you expect to have qualifying tax abatements? And we're asking you to select all that would apply. We'll give you about 30 seconds to respond to this, and we'll be interested to see, because we have a very significant cross-section. Last time I checked, there were something on the order of 150 people participating from really across the country. So please select those programs you think are going to be most, that you are most likely going to be reporting GASB 77 tax abatements. So let's look at the results. Property taxes, the most common, obviously. Sales and use taxes, obviously a big component. I will be very interested to understand the none of the above, but there may be some entities that are participating in this webcast that are not doing financial reporting or have no tax revenues that are going to require reporting of abatements. With that, Jim, I'm
John,
going to turn the program back to you, and
okay.
We'll go from there.
Yeah, on the none, I'm not too surprised. I know there are a number of universities and university representatives that may be on the call today and also trying to determine if this impacts them. And it's possible that they are not sharing in tax revenues to begin with. But there's a lot of community colleges that are eligible for property tax revenues, and that's a significant part of their revenue stream. So they're clearly going to be impacted. So for some entities, it's just a matter of understanding, geez, do I participate in a tax of some sort? Is that part of the revenue stream that comes into my coffers? And if so, then the next step, is there a tax reduction program associated with that? And it's a challenge, as you mentioned in your previous set, just the fact that there may be another government that actually does the assessing and collecting and distributing on your behalf, and you get a net amount. So knowing, sometimes you may think you don't have an abatement program, but it may be that it's never really clearly been disclosed to you how an abatement program may be reducing the net amount that ultimately gets distributed to you. So in terms of measurement and implementation issues, this is maybe this is just a very high level process that you might go through, but we've kind of hit on this pretty good. The first step is, hey, what are the taxes that come into my organization? Once you know that you've got some tax revenues, now it's that process of figuring out, is there a reduction program in there? So state laws, state statutes. If it's a locally assessed tax, then elected officials' minutes or resolutions, ordinances, charter provisions, any of those might contain information about reduction programs and so forth. Then, once you've identified, yep, I've got a tax, yes, there appears to be a reduction program of some sort, then it's running it through this filter, John, that you walked us through. Is there an agreement? Is there some sort of an agreement where both parties have some obligations to perform or to meet some goal or objective? Then we're going to start talking now about, well, gosh, now let's assume I've got one wired. Yep, I've got an abatement program. Well, where does the information come from to give me what I need to put in my footnotes? How do I calculate the dollar value of the abatement on an accrual basis? And I think we'll find there's going to be a high reliance on parties outside of my organization to get there. And so who are those stakeholders and how do I reach out to them? It'll be interesting to hear some of your stories, John. For me, working with the assessors, when I walked into, we've got several counties as clients in Oregon, and when I walk into the assessor's office, they look at me with this deer in the headlights. It's like, Jim, you took a wrong turn. Finance is down the other way. So they don't know about accounting standards and have never really been involved in the financial statement preparation process. So getting stakeholders educated on their role, or what we hope will be their role, to help us. Then it's a matter of, well, what's the action plan and dates and milestones, because we all are going to be closing our books after, assume most of you are on June 30 year ends. That'll be coming up in June, and we need information probably no later than early July to start thinking about drafting our statement. So there's a lot of work that needs to happen between now and then. So that's maybe a real high-level overview of maybe a process that could occur here. And here's just a graphic that kind of walks you through the same thing. And in particular, how to evaluate maybe the agreement part of it. And then, am I scoped in or out? So this might be just a helpful graphic to walk you through whether a particular reduction program will fit the criteria. So it's kind of a fun way, I think. I would hope that there will be other flow charts that we could develop, or tools that would help us in getting down to which of these are likely to be scoped in.
Jim, I think one of the most common questions we've heard is what is this agreement requirement? How do you identify the agreement? If it is written, that's a little bit easier. If it's implicit, that is obviously a challenge to understand the specific terms of the agreement. But that first filtering item, is there an agreement, is a critical filter or hurdle to cross in this template, if that's a good way to say it, of the process in which you evaluate these tax abatements. One of the comments that GASB has made is that with respect to these specific agreements, it's the substance of the transaction that matters, not the title of the program or other verbiage, but is it an agreement that reduces the revenue, the tax revenue that will be paid to the government, and is there a activity that a performance requirement that is part of the agreement. Of course, the next step in that is, are tax revenues actually reduced? That's probably the simplest of the components to evaluate here. And then the specific purpose is really probably the critical filtering element in terms of focusing on the details of the transaction. For the most part, the original thoughts were that this was related to economic development and other public benefit types of programs, but GASB provided a preliminary list that included activities that increase the tax base, that address cost disadvantages in particular sectors or business activities, that retain or attract new employment, new jobs. Historic preservation has been identified as one of these purposes, environmental incentives, cleanup of brownfield environmental issues are a part of what GASB has identified. And one of the more obvious ones is housing construction. We would be remiss not to mention that the city of New York, on its own volition, decided to report its GASB 77 tax abatements prior to the date that they were required to, and that's now out there and available for you to look at. In that report, they identified $5.5 billion worth of tax abatements in the city of New York, and about 60% of those are related to housing programs that have tax abatement provisions.
And John, we're going to find that pretty common in Oregon too. Multiple unit housing, low-income housing is a common property tax reduction program, which I believe is likely to be scoped in. And we do have a couple questions. One is pertinent right now, which the question is, do pass-through grants from the federal government, so grants through the government, through the state, and ultimately to the recipient, would they qualify? And generally, grants are not tax sources. I suppose they could be, but you'd have to know for sure that a grant, the source of that funding, that grant, was actually a tax. Most grants are not pegged to the revenue stream that funds them. So as far as I know, federal grants would not be within the scope of GASB 77.
We also have a question with respect to what clawbacks mean, and it is a somewhat common concept in particularly economic development programs, where if the developer fails to fulfill its obligations, the government entity is able to claw back the benefits that were obtained under the program. That is, there is a repayment obligation by the developer in that context. Turning then to some of the data sources, it is probable that there will be a lot of this information that can be obtained from direct data sources. That certainly the property tax information is recorded and available in the county assessor records. There are tax credit claims that have to be filed with a state tax department or possibly a local government entity. And there are tax distribution reports that help to identify the dollar value of taxes distributed and may be a beneficial tool in identifying the taxes abated. However, anybody who's worked in tax expenditure analysis understands firsthand that not all the information you need is reported, particularly if you, for example, consider a total tax exemption that would qualify. There's likely no information reported by the taxpayer. They're exempt from taxes, and unless there's a specific statutory provision related to that exemption that says you have to report information about your business activities to claim the exemption, there may be nothing on file that would help you to estimate those tax abatements. So you have to turn to secondary sources or indirect sources. There are a variety of tools and databases out there that you can rely on to estimate economic activities. There may be data that you can extrapolate from. For example, employment data would be potentially a valuable tool in understanding the scope of the economic impacts of the tax abatements. And at an extreme, for public companies, you may be able to rely on their annual financial reports. However, the timeliness of those reports may be a significant constraint to utilizing that kind of information as a foundation for your calculated values of abated taxes.
So I'll take this one, John. Just kind of piggybacking on your last discussion, what I think makes the most sense is if there is a common entity that has the data, can we go to that and get the reporting we need to have the consistency? So again, using Oregon as the example, property taxes are going to be the primary source of tax abatement programs. There's 36 counties, 36 assessors that are involved in the property tax database. They do the assessments, the collections, and the distributions. So can we work through that entity to help us get the data so we're not all trying to determine it on our own? Now, there may need to be collaboration, but perhaps if the state is the originating entity, then can we go to the state and get some help at that level and then have that common entity report out to its stakeholders the information necessary to be reported. And so obviously from a preparer standpoint, there's a completeness and accuracy assertion that will need to be addressed. How do we determine that all the programs are identified and that we have an accurate calculation that reduces that to a number to go into the disclosures? And then finally, should there be an attest function? Let's say we get 36 counties to put out a report on with the information by jurisdiction. How do preparers know that they can rely on that? And then finally, how can their auditors, how would they get the audit evidence necessary? So there may need to be an attest function of some audit or attest on a report that comes out. Thus the need to kind of talk about this now and get an action plan in motion while we still have some time in preparing for meeting the timeline of this standard. Now, one thing that I've heard a lot, John, is, gosh, what's the materiality of this? And that is always overrides here. Do I need to be worried about this? Is it going to be material to me? I think the challenge we face is that we're not going to know what's material to an individual entity until there is an effort to calculate to identify them, reduce it to a number, and then let me know. I know that some cities are very aggressive in their economic development programs, and so they have a number of abatements, but maybe within a county, the smaller cities, maybe they aren't attracting or trying to be as aggressive in their economic development or low-income housing initiatives and so forth. But until there's an effort to go through the computation and determine numbers by local government, it will be very difficult to know if we can play the materiality card and maybe get out from underneath the disclosure requirement.
Jim, I think another important comment in that regard, beyond the materiality, is the consistency of reporting between these stakeholders. It would be difficult to imagine that you would have drastically different estimates and not have somebody question that, but it also becomes a timing issue. This is information that is going to be very difficult to assemble in some cases. For example, if when a industrial revenue bond is issued and the title to the property is retained by the government entity until the bond is retired, the county assessor may not be updating the property values because it is a property that's held by the government entity, not subject to property tax at that time. These are issues that make it difficult for shareholders to work together and address. So going to another one of our polling questions, we'd like you to address whether you feel comfortable that your organization has the capability to identify and collect the data that will be needed to comply with GASB 77. You would select the answer that most closely fits your expectation. We will give you a couple seconds here to answer that.
And while they're doing that, we did have one question and we've got a bunch of questions here. We're going to get back to all of you. We may not be able to in the scope of this presentation. So any of you that have asked questions, we don't get to it, we will definitely get back to you. But there is one in here regarding urban renewal agencies and whether that's likely to be scoped in. The answer to that is it depends. But fortunately, most urban renewal districts or tax increment financing programs will be scoped out. And in Oregon, as a matter of fact, I'm pretty convinced now that we will be scoped out because the tax increment financing program is not an abatement. There's not a reduction in tax. A taxpayer doesn't get a break on their taxes. What happens is some taxes are collected and redirected to the urban renewal district, usually in repayment of debt that they took out to advance their programs. So it's not a tax abatement program, it's a redirection program, if you will. The only reason they may be scoped in, apparently we're finding, or the GASB is finding, that some states, their urban or their tax increment financing programs can result in a check being cut back to an individual taxpayer. So there really is an abatement element, and I believe that's lacking in Oregon anyway, and probably lacking in most states that have TIF programs, but that will have to be evaluated to know for sure.
Well, Jim, I'm feeling very much more comfortable that either we're doing a good job of these presentations or we've got a very sophisticated audience because they feel that they have the capability for the most part to address these standards, and I'm encouraged by that.
Well, that's good news because we're a little bit concerned. Well, maybe we could talk a little bit about, these stakeholder initiatives.
I think this is a good illustration just to give a sense as to this is just a simple Venn diagram, but you can see that the enacting authorities are just the smaller subset of the potential stakeholders. And there's not much to say beyond this that other than certainly all GAAP reporting entities are stakeholders, but it is also the users of the government financial reports that will be very interested in this standard. And then, Jim, I guess let's turn it over to you and talk about some of these specific issues associated with stakeholder identification.
Well, we'll move pretty quickly here. We've hit on this pretty good. The issue, in fact, we had a question, and I don't know which state this came from, probably Oregon, a question from a school district. School districts rely heavily on property taxes, and so very definitely school districts will be impacted by the standard. The issue is that they generally don't generate the abatement programs. They don't have control over them. But guess what? They have a disclosure requirement to disclose other entities' abatements that impact their collection. So understanding who all is initiating these that has an impact on me, and then where do I go to get that information? So very clearly understanding all the stakeholders involved. I liked your slide, John, previously that gave a graphic illustration of that will be a real challenge. And really just the capability, once I know who the origin is of an abatement program, are they going to have the capability to do the computations? We're in Oregon going to county assessors. I mean, the last thing they want to do is spend time helping their governments within their jurisdiction come up with the information they need to disclose. So it's pretty hard to tell them that they should take their constrained budget and put some of those resources toward helping jurisdictions meet an accounting disclosure requirement. So even if we can identify the stakeholders, the origin, where we need to go, how do you get them to voluntarily agree to take on this initiative to help us out? So that will be a pretty key thing. I think, again, just using the Oregon assessor example, we're fortunate that they've given us an audience at their annual meeting, and there's a work group that has been established to work on this. And so we've got some movement, but in other states or jurisdictions, is that effort happening? And is there still time? And just to make sure everyone gets the CPE credit they need, let's get through the last Q&A here too. So what discussions have you had regarding this standard? Give us a little bit of info about how far you are along. Have you talked with your external auditor about this?
While they're answering that, Jim, there's a question as to the need to report payment in lieu of taxes as part of the GASB 77 reporting. And yes, we believe that you would report not only the taxes abated, but any pilot payments that were received in conjunction with that tax abatement.
Well, let's see how folks answered this. So this is pretty much what we found, isn't it, John? I think people are aware. They've probably been to some CP. They're hearing about GASB 77. There's probably a little bit of internal discussion, but not a lot of outreach to stakeholders, auditors, other parties that are involved. So we're going to honor folks' time. We're just about done here. And when we're done, I think Pam might have a couple wrap-up elements for us. But in summary, I think we've hit the challenges. So we need to identify taxes. We need to identify if there's a reduction program. But then we've got to find that intersection of an agreement, an existence of an agreement that has the right elements to it. Then it's a reach out to stakeholders, and how do we get that timely? Those are the big issues there. And again, we will get back to all of you that had questions that we haven't answered within the course of this. And Pam, would you take us home here?
Sure. Thank you, Jim and John, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open the icon and click the printer icon in the lower right corner to download a PDF copy of your certificate. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will also be emailed within 2 weeks in case you have any difficulty downloading it now.
And Pam, in case I missed it,
sure.
Yeah, how do they get the presentation materials?
Oh, the presentation materials. We will be sending a follow-up email, but in the meantime, a copy of the slides are actually available in the webcast console. You should see something in, it probably looks like a file folder icon, and so slides are available there right now as well. But if you have any difficulty locating it, we'll send an email along with the webcast recording, and the slides will be included in that email as well. And then finally, feel free to visit our website. We've got a couple of different articles and alerts that you might find helpful there. And also, here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey, as your feedback is very important to us. Thank you again for joining us, and we hope you'll join us again next time.